Hello, and welcome to the second part of Mastering the Markets presented by Wallstreetmob. Now that we have covered the basics of the stock market, now we're going to get into options trading. Just like just like stocks with options, you have a bid by ask price. Now, you'll notice that the bid by ask may be a little wider than it is with stocks. And keep in mind that you can also negotiate the price that you pay for a contract. So let's just say the asking price is $2.55. You can negotiate like a third of this price and you could put in like a limit order for like 245, and the market may fill that order at 245. So options trading essentially comes down to two contracts, calls and puts. Calls give you the right, but not the obligation to buy a stock at a set price before expiration, while puts give you the right to sell. So traders essentially buy calls when they expect the stock to go up, and if the stock raises above whatever strike price you choose, then you'll make a profit. And puts work the opposite way. If you expect a stock to drop, you want to buy a put. And if the put falls below that strike price, then that put gains value. So calls profit from upside moves while puts profit from downside moves, and master these, and you're going to be mastering the markets. So next we're going to talk about strike prices. And with strike prices, you could have different increments, and the increments really just determine or depends on how, like the size or the price of the stock. So you'll notice that stocks that are cheaper have strike price increments that may be like 50 cents, where your larger stocks and your larger contracts, they may have strike prices of like $5. And I'll show you what this looks like later. It's important to understand that when trading options, one option contract controls 100 shares of stock. Next, the option price is called the premium. And the premium is the price that you would pay for that underlying contract. For example, if you see a contract for $1, the premium will cost you $100 to get into. Okay. So when trading options, you'll hear terms like in the money, at the money, and out of the money. These describe an option that has intrinsic value. So a call option that is in the money, a call option that is in the money means that the price of that stock is above the strike price, right? And that means it has intrinsic value. It has built-in value, right? Now, a put that is in the money is a put that is priced below the strike price. Okay. Now, in the money options, you're going to find that they cost a little bit more than out of the money options. But the reason they cost more is because they have built-in value. So it's going to cost you more to get in. And although you're going to see, and then if you buy right at the price of that stock, it's called at the money. So let's just say a stock is $100. Using this example, and you buy a call for $95. So you're saying, hey, I think this stock is going to reach $95 by whatever this expiration is. It's if it's at $100, it's already reached that price. That's why it has that built-in value, right? Whereas out of the money, you think the stock is going to keep going up, but you buy a strike price at 105. That's out of the money. So the stock is going to have to move to 105 before it starts gaining real value, before it has built-in value. So write this down. Rule number one, make sure when you're buying an option contract, make sure it is in the money and we have built-in value. So the delta is one of the most important Greeks when it comes to option trading. There are more Greeks and we'll get into those later, but just for the basics, we're going to stick to just the delta. Because the delta measures how much, basically how much money you're going to make for $1 that the strike move or that the stock moves. So if the stock goes from 100 to $101, if you are out of the money, you're going to make $25. This is just an example. I'll show you how to find the delta. If you are at the money, you may make $50 for that $1 move. And then if you're in the money, you may make $75 for every $1 that that stock move. And please note, while I'm telling you to always trade in the money, if I ever show you trades that is not in the money, it's because I'm more experienced and I probably trade more aggressive. Okay. So just keep that in mind. Always do your own research and know what your risk tolerance is. And so with puts, you'll find that the negative or the delta is negative, and that's because the stock has to drop value. So you'll see a delta of like a negative 50. And that essentially means for every $1 that the stock drops, you'll make $50. And also, just like a little tip, the delta can also estimate the probability of that stock being in the money by expiration. So a higher delta, the better the odds. That's why I say we want to trade in the money. So rule number two, when buying in the money options, look for a delta between 70 and 90. And sometimes you may have to move your strike price up. So let's just say the stock is trading at like $100. We'll just keep that 100 for our example. And the 95 strike price may be trading at, or may have a delta of 50. The 90 may have a delta of 60. The 85 may have the delta of 70 or 90. So you may have to just move down a few strike prices before you see that 70 to 90 delta. Now, all option contracts have an expiration date. The deadline for those contracts can be exercised at any time. You don't have to wait for it to expire, and you actually don't want to wait for it to expire, okay? We want to get out before it expires because you don't want your contract to expire worthless, okay? So with your weekly options, you'll find that the stocks have weekly options, monthly options, then there's like short term, midterm, and long term. So the long terms are called leaps, and you also have your quarterly options, right? Quarterly options expire the last trading day of each calendar quarter. So in March, June, September, and December. Now, what you'll notice with these, it's going to appear that the market is, the bottom is falling out the market, but it's people probably repositioning for those quarterly options. And typically you find the quarterly options on like the indexes. You have your monthly options that expire. Well, we'll get into that in a second. When it comes to trading, let's go here. Okay, so when buying monthly options, you want to trade those at least like 6 weeks out. So my rule of thumb is you don't want to trade a monthly option in that current month. In the month of expiration, you don't want to be in that option because you have what's called time value, and it's going to experience time value decay, and you don't want that. So when trading monthly options, you want to make sure you're out, within like 3 weeks of that expiration date, but no later than 2 weeks. You don't want to be in that trade the day of expiration. Okay. So this just kind of goes over, the monthly option expires the third Friday of the month. You want to make sure you are out before this first Friday of the month. And in reality, the week before that, okay? To be on the safe side. If it's running, you might want to stay in it longer, but if not, go ahead and let it go. Next, you have your weekly options. So you typically want to get into your weekly options on Friday, play them Monday and Tuesday, and by Wednesday, make sure you exit those trades because of time decay again. So essentially, you want to enter your trades on Friday, and you want to make sure you're out by that following Wednesday before expiration. You do not want your contracts to expire because the closer they get to expiration, one thing you may notice is that the stock price may continue to go up, but you'll notice that your delta may be decaying. Then you're going to have time decay, and your stock price or the option contract may not be making as much money as it would earlier, early on. So you don't want to be in a trade after Wednesday, a weekly option. Okay, so our stock rules, we want to make sure we check our stocks. We want to look at our line charts, right? We want to determine, is this stock bullish, bearish, or is it channeling sideways? That's the first thing you want to notice. And I like to tell people, look at the big picture. You never just want to look at today. Pull your chart out for 5 years, 2 years, 1 year, and just, bring it in to where you look at the big picture first, and then you bring it in. So yeah, then you bring it in because you want to determine whether or not the overall stock is trading bullish or bearish before you decide to make a decision. When getting into stocks, you want to make sure earnings is at least 14 days away. And the reason I say this is because during earnings season, that's what they call it, is the stocks tend to be very volatile. So you just want to make sure earnings is at least 14 days away. And when trading options, you want to make sure your option contract is in the money. You want to make sure you have a delta of 70 and 90. And then once you get into your trade, make sure you set your stop losses so we can protect our portfolio. Okay, so essentially that was like the basics of options trading. So now we're going to get into those things, like things that will help us make decisions and different strategies that we could use to make a decision to determine our entry and exit points. So as traders, we like to use what's called technical indicators. And technical indicators is just tools that we use to analyze price action, trends, momentum, and it's all based off of like historical data that will help us predict future movements. So some indicators like moving averages show trends by like smoothing out the price. And then others like RSI help traders spot whether a stock is oversold or overbought. Now, indicators do not guarantee, it does not guarantee, what the stock is going to do. But it will help you make a decision, okay? So we're going to discuss on the screen are like some of the most commonly used indicators. And I'm gonna go over the main three that I personally use. You guys can write this stuff down and do more research. But just for the basics, I'm gonna show you just basic technical indicators that can help you make decisions when it comes to trading. So next, we're gonna discuss the MACD, RSI, and Bollinger Bands. Okay. So your MACD or your moving average convergence diversion is a momentum indicator that helps traders spot trends and changes in strength, okay? So when the MACD line crosses above the signal line, it's a bullish signal and momentum starts shifting up. And when it crosses below that line, it's bearish and momentum starts to weaken. So the photo we have right here, it shows the difference between those lines. Bigger bars mean stronger momentum, while the smaller bars is a signal for a potential reversal. Okay. Now, as a trader, we use the MACD for entry and exit points. And the way you would do this is when at whatever time period you're looking at, whenever these lines cross over, it's going to be significant movement. So just follow me and just see how every time the line crosses over, what happens next. Line crossed over a little bit right here, but you see how small these were? So it really wasn't like a huge increase, but it did increase some. Line crossed over. Do you see the momentum? So as traders, we want to use when the Mac and see right here, this is showing that the MACD is getting ready to cross over. This is what we want to see when we're looking at the MACD, but we want to actually make sure it crosses before we enter a trade, okay? And again, this is not 100%. It just helps us make a decision. Next, we're going to talk about the RSI or Relative Strength Index. And it's also a momentum indicator that tells traders whether the stock is oversold or overbought. So when the RSI gets up here around 70, that means that the stock could be considered overbought. And we start selling, we start taking our profits, the stock going to start going down. Do you see how all of this stuff correlates? It'll all start making sense. Then once the RSI gets around 30, it's an indication that the stock may be oversold, and now it's a buying opportunity. So as you can see, once it reached down here around 30, it bounced back. This bounced back. The stock also like went up some. So we use the RSI to help us determine entry and exit points um when the stock to determine, and also to determine whether it's oversold or overbought. But of course, again, do not trade blind. Do not simply rely on RSI to make a decision. We have to bring it all together. Next, we're going to talk about Bollinger Bands. Your Bollinger Bands are like a volatility indicator, and it helps traders spot potential breakouts and reversals. So it consists of three lines. The middle band is the moving average. The middle band is the moving average, while the upper and lower bands expand and contract based on volatility. Okay? So when the price touches this upper band, the stock may be considered overbought and it's time for a pullback, right? So if you see how it touches that upper band, it also crossed over MACD, and we see what happens next, right? So when the band squeezes, it means that it's low volatility and it often signals a pretty big move. So you also want to notice that when the stock hits the bottom of the Bollinger Band, it typically will bounce back either to the moving average or like towards the top of the band. And you can see right here how it went to the top of the band. So you just want to use your Bollinger Bands to kind of measure where that stock is, because if you see it trading down below, it may be time for a bounce back, or trading towards that bottom line, it could indicate it's time for a bounce back. While if it's trading towards this top line, it may pull back and come down some. So again, you want to look at the Bollinger Bands and use the Bollinger Bands to help you make a decision. So you can also catch like breakouts and stuff right when they happen. Okay, so just to sum everything up, these are different outcomes when trading options. If you believe that the stock price is going to go up, buy a call. Buy a call. We're going to buy to open a call if we think the stock price is going to go up. If that stock price goes up, we're going to win in that trade. If the stock price stays the same, we're going to lose. If the stock price goes down, we are going to lose if we buy a call. Y'all write these down. Write these down. Keep them with you when it's time to make decisions, when it's time to trade, okay? Now, next, if you believe the stock is going to go down, you want to buy a put, and if that stock price goes down, you win. If the stock price stays the same, you lose. If the stock price goes up, you're going to lose. So if you see buying a put, you're going to win or lose 2 out of 3 times. Okay? You only will win if the stock price goes down. Now, remember I told you in the beginning we can sell to open, right? So if you think that the stock price is going to go down, you want to sell a call. You can sell to open a call. If that price actually goes down, you win. And if the price stays the same, you win. You win. And so if the price goes down or if it stays the same, you win. So on this, you win 2 out of 3 times. Okay, selling a call. Only caveat, you have to own the security. where when you just buy a call, you do not have to own that stock. But if you sell a call, you do have to own that stock. And next, you can also sell a put if you think that the stock is going up. And again, to sell to open, you have to own that security. If the price goes up, you win. And if the price stays the same, you win. But if that price goes down, you're going to lose in that trade. So again, make sure y'all write this down and keep this in mind when you first start trading. All right, y'all. So that's pretty much the end of the training. That's the end of the training. Check us out. Follow me on TikTok at Wallstreetmob. Follow me on Instagram at Wallstreetmob for options trading. And we also have a Discord group where I'm going to share the Discord group for you guys to get connected in our Discord so you can get trade alerts and you can also stay updated on my particular trades that I have and how my portfolio is doing. And then you can also ask me questions and different things like that. So make sure you join our Discord. I will have the link below. And thank you so much for attending this training. And I wish you nothing but the best on your trading journey. And blessings.